I am not at all surprised by the numbers, but we should check the risks and opportunities. Hello and welcome back to your friendly value robot channel for a new quick stock analysis. Today we are not going shopping, although it is highly related. We will use our DCF template to see if PayPal is worth a deeper dive or if it should go to the too hard pile. Jump in. Before starting, I would like to disclose that I do own PayPal stock, so always take into account the potential incentive any content creator may have when sharing their opinions. If you're interested in learning more about my stock portfolio, including my strategy, current positions, and performance, make sure to subscribe. Now, as you can see, I have my analysis template ready. For now, it's blank, so let's start by stating which company we are going to analyze. I always have my previous analysis at hand, so I can copy some data and do this faster. I will paste the ticker, and you can see the data is already being loaded into the template. Paste the record of previous analysis that we have done and their results. I will prepare a new row for today's analysis and leave it blank, ready to be filled at the end of the video. Okay, so I have my income statement, balance sheet, and cash flow statements copied from the ticker terminal site. Our process will be guided by the checklist we have established to ensure the quality of the business. Please check the video on top if you are interested in learning more about how to establish your own checks. Let's start with the income statement data. We can copy the revenues and the net income in just one go and paste them as values. When it comes to revenue, we can see that it has been growing steadily for the past 10 years. Use the graphs to help you visualize the data. The growth is a little bit lower than it used to be a decade ago, but it is still positive revenue growth. So, this is going to be a check for me. Now, regarding net income, we can see an 11% overall growth, but it is not as steady as the revenue. Still, from 10 years ago to now, we can see an increase in net income, although we might be interested in learning what happened here in 2022. Since we are doing a quick analysis, this is going to be a check for now. If we do a deeper dive on the stock, we should try to find out the reason for those jumps. Let's continue with more information we can find in the income statements, such as the number of shares outstanding. Overall, it's a good sign because they have been buying back shares nearly every year, reducing the count by about 2%. If we chart it, we confirm that they have been buying back more shares in recent years. However, be careful, as this may have been incentivized by the low interest rates we had in the past. In any case, it's going to be a check for our criteria. We also check if PayPal has a dividend, and it does not. Moving on, let's check the balance sheet and see how it looks. We copy the cash and cash equivalents and short-term investments. We do the same with the total debt and paste it below. The net cash position is negative, meaning we will have to deduct this amount from the intrinsic value calculation at the end. Since we are using a template, it will be automatically deducted. Move to the cash flow statement and copy the cash from operations line, as well as the capital expenditure and the free cash flow. Paste this data into the historical data area. We have quite good values with yearly growth around 15%. If we visualize it as a graph to have a visual representation, it's obviously not as steady as the revenue, but there is still growth over time. I'm going to mark the cash flow growth as a yes, and we will continue with the checklist. Time for the valuation metrics. P/E ratio and price to cash flow. When it comes to price to earnings, it's around 14, so that's going to be a yes. It's even lower when checking the price to free cash flow metric, as it's below 10. So it's going to be a yes for us as well. Now that we have the free cash flow inputted into the template, we are going to check the debt payoff period. We want it to be below 3 years, and we can see it will take less than 2 years to pay off all the debt if all free cash flow from last year was dedicated to that purpose. The lower, the better. As always, I have the ticker terminal site open on my second screen. I'm going to go into the financials and ratios section of the site, where I will check that the return on invested capital is 18.7%, which is well above the 9% we are looking for. Continuing with the current ratio, it's 1.43, so that's good. The current assets are bigger than the current liabilities. And last, the total debt to equity is around 60%. It won't be a perfect check, but it's not bad either. So, I'm going to mark it as an in-between. Moving on to the last part of our process. It is the most important step since all calculations are based on these values. We are going to go to the ticker terminal site to the estimates section. You can follow along, do not hesitate to pause the video if needed. Paste projected free cash flow values below. I will manually write these values in billions on our discounted cash flow template, and start making assumptions about future growth rates in order to calculate our intrinsic value. Based on analysts on the ticker terminal site, we are expecting a 4.5% CAGR. The CAGR is calculated based on the projected growth between the last available free cash flow figure, 2024, and the last analyst estimate, 2027. Historically, free cash flow growth has been between 14% to 16%, and analysts are saying that future growth will be around 4%. Let's say 5% to round it up. Since we want to be conservative with our values, I'm going to set the growth rate at 10% in the best case scenario. This is neither the analyst's estimate nor the historical data, which might be too high. I'm going to leave it at 5% in the normal case, which is aligned with the analyst estimates, and I'm going to set it lower at just 1% for the next 5 years and also for the 6th year. So, what is our intrinsic value result? Based on all previous assumptions, we come up with an intrinsic value of $95 billion for the market cap, which is equal to $100 price per share. What is our index ratio then? We end with an index ratio of 1.5 for PayPal. That could mean we are looking at a good opportunity here that we should look more into. But before, let's take a moment to consider the major risks and opportunities for PayPal. The main risk is the highly saturated digital payment space, where powerful rivals like Apple Pay, Google Pay, and Block's Cash App compete in the consumer segment, while Stripe and Adyen dominate the merchant backend, competing with PayPal's Braintree. The second risk I would like to highlight and often overlooked by the market is that PayPal's performance is directly tied to global e-commerce volume and consumer spending. A significant economic slowdown or drop in discretionary spending would directly reduce its total payment volume. On the flip side, let's explore PayPal's key opportunities and strengths for future growth. The growth opportunity lies in Venmo's transition beyond peer-to-peer payments. It is now increasingly accepted by merchants, enabling its use on e-commerce sites and at the point of sale in physical stores. Secondly, strategic partnerships, such as the deal with Google, integrate PayPal's tools across major platforms, while AI investments are improving fraud detection and risk management. Is then PayPal worth a deeper dive? PayPal demonstrates strong fundamentals upon initial review. The company's present and future cash flows appear healthy, with continued growth expected. Debt is well managed, and share repurchases are consistent. Currently, the stock appears undervalued, offering a small margin of safety. From a risk assessment perspective, I do see potential issues in the horizon as well as some opportunities. As previously disclosed, I am personally invested in PayPal. Please remember to conduct your own research. Value investing requires more than just punching numbers into a template, though a good template is essential for avoiding unreasonable valuations. I hope you enjoyed the video as well as I did making it. Don't forget to like and subscribe, and see you in the next one.